Today, I'll pick that up later. Today, it's great to be here. I'd been promising David that I'd do something for OMFIF for a long time, so we finally made it happen, and it's a pleasure to be here. Thank you to all of you who are attending either in person, very good to see so many people on a Monday, or online. And at the end of the year is always a natural time for reflection, and this time last year I gave a speech on banking resolution, looking back over a year influenced by the failures of Silicon Valley Bank and Credit Suisse. And a year before that, I reflected on the significant shocks that had struck the UK economy in 2022, and David was just alluding to one of them. So at the end of 2024, I thought I'd take stock again and survey the landscape of the UK's financial system. And I'll do that from my perspective as the bank's deputy governor with executive responsibilities for our balance sheet operations, but also as a member of the bank's Financial Policy Committee, the FPC, and the Prudential Regulation Committee, the PRC. Now, approaching financial stability risks from that vantage point allows me to think through how we get the balance right in terms of monitoring and acting on risks first at the firm level, then at the system-wide level, and then in both those pursuits, considering how the bank's balance sheet can be best put to use in maintaining financial stability. And I want to pause on that final point for a moment. What do we mean by maintaining financial stability? As my colleague Sarah Breeden set out in September, financial stability is a concept that can be hard to pin down. In its simplest form, we can describe it as the absence of instability, but more fully it means the financial system provides vital services to households and businesses reliably in all states of the world, even when shocks hit, which in turn lay the foundations for sustainable growth. Now, Figure 1 maps out the various contributors to financial stability in the UK, and it's in my role that I sit across the system-wide issues as an FPC member, as well as firm-level risks for banks and insurance companies as a PRC member. And as Sarah Breeden set out, though, we don't want to insure against every possible eventuality, instead ensuring resilience to severe but plausible shocks. Now that implies that disruptions can still occur, and means we at the bank must be ready to intervene when necessary. And that is where my responsibilities as a bank executive come in, for the market operations in the far right purple box, and the bank's resolution function in the adjacent box. Now, for sake of argument, let's take the simpler description of financial stability for a moment and run with it. One standout aspect of 2024, especially when compared with the last couple of years, is the relative lack of systemic risks crystallizing through the year. Despite ever-present geopolitical risks and some large moves in markets at times, we haven't had to intervene to address market dysfunction, nor have we had to deal with shocks spilling over into significant bank resolutions. But does the absence of instability mean we've achieved lasting financial stability? It would be a very brave FPC member or deputy governor who said that. Now, whilst there hasn't been any significant market dysfunction or bank failures, there's still been significant volatility, not least in early August, where we saw the unwinding of leveraged trading positions, particularly in the yen carry trade, exacerbate market moves, as highlighted by the path of the VIX index shown in the chart here. We've also seen moves in rates around the UK budget and the US election more recently. Indeed, I do not want to convey that relative stability within the UK means there's been general stability globally. In just the last week, we've seen martial law imposed and reversed in South Korea, the French government lose a no-confidence vote, and other geopolitical developments just over the weekend. So while the August volatility didn't lead to market dysfunction, had subsequent macroeconomic news been less supportive, further deleveraging could have occurred as market-based finance vulnerabilities remain elevated. From my perspective, the episode highlighted yet again that correlated leveraged positions, when unwound, can act to amplify an initial shock. Notably, it was another example of how vulnerabilities in market-based finance can crystallize. We've previously set out at some length, but summarized here in figure 2, how vulnerabilities in market-based finance affect financial stability, where firm-level vulnerabilities like leverage, that's the first darker orange column, interact with system-wide vulnerabilities like concentration and correlation in the lighter orange column to amplify shocks. To me, the August events provided another piece of evidence suggesting that we're seeing structural changes consistent with a new tendency to volatility in financial markets and the wider system. Nikhil Rathi, the FCA's chief executive, has described the developments as predictable volatility, whereby developments in technology alongside greater market concentration and interconnectedness mean we're more likely to see large swings in prices, particularly intraday, as markets can react faster to information and are more prone to herding behavior. Now, is that new volatility a sign of increasing financial instability? No, it's not. Market volatility does not equate to financial instability, but we have to monitor and act on those developments appropriately at the firm level, system-wide level, and importantly, in the operation of the bank's balance sheet. So today I want to reflect a bit more on what we've seen in 2024 with its lack of significant dysfunction but continued volatility. I'll first consider what developments are taking place in the UK financial system, with the focus this year firmly on the non-bank sector. I'll then go on to set out how risks at the firm level could transmit to the system-wide level and comment on what the bank is doing to monitor those risks. As Andrew Bailey emphasised in October, we must keep our focus on the system-wide perspective in assessing financial stability risks. I'll then set out how we're utilising the bank's balance sheet to support financial stability. Now, much of this will be familiar. You and colleagues have heard a lot from me and my FPC colleagues throughout the year, but it bears repeating given what it implies for existing and new vulnerabilities and risks to continued financial stability, which the FPC and the bank are managing. If I was going to pick out one theme to describe 2024, it's the continued transition of activity to non-banks, particularly in some core markets. Non-bank financial institutions, or NBFIs, encompass all financial institutions that are not banks, central banks, or public financial entities. So that means they're a heterogeneous group of financial intermediaries with widely differing business models, varying from pension funds and insurance companies to hedge funds and money market funds. And as has been well documented, their role within the financial system has increased rapidly since the global financial crisis, with non-banks now accounting for around half of the total assets in both the UK and global financial systems. Nearly all of the increase in net borrowing by UK business since the global financial crisis has come from market-based sources rather than direct bank lending. And market-based lending now accounts for 56% of the £1.4 trillion stock of UK corporate debt, as shown here in the figure. Now, the bank has previously set out the reasons for and impacts of that shift in household and business savings and borrowing habits and market activity towards NBFIs. There are potential benefits to that shift by increasing the range of intermediation channels, reducing concentration, and improving risk sharing. But we've also noted how non-banks can pose new forms of liquidity risk to financial stability in the context of the post-global financial crisis era. At a system-wide level, that greater vulnerability to sudden jumps in liquidity demand has warranted thinking from us on how we should utilise our balance sheet as a backstop to support systemic market functioning in the event of a non-bank liquidity episode. I'll come back to that topic later, But reflecting further on 2024, there are lots of developments I could highlight in a longer speech, and they're all set out in the latest financial stability report that came out about 10 days ago. But one particular development I want to draw out is what we're seeing in gilt markets. It shows three key things. First, activity in core markets continuing to shift to non-bank participants, particularly hedge funds. Second, firm level vulnerabilities among those non-bank participants evolving. And third, structural changes amongst those participants suggesting system-wide vulnerabilities that can amplify shocks. Working through each of these in turn, first, as chart 2 here shows, an increasing proportion of gilt market transactions have involved hedge funds over the last few years. Some of the reasons for this are not surprising. While the volume of government debt outstanding has increased in recent years across advanced economies, particularly since the COVID-19 pandemic, commercial bank balance sheets have not kept up. And until recently, central banks absorbed some of that supply in QE programs, a trend which has now moved into reverse. As a result, government bonds are now often warehoused beyond the banking system and central banks. This has meant hedge funds have become increasingly active in intermediating risks between borrowers and lenders in markets. Now, there's nothing inherently wrong with the growth in hedge fund activity. Indeed, it's a trend that began well before 2024 and is not unique to the UK. Ultimately, it's important that there are participants providing market-making services within UK core markets, and hedge funds are increasingly taking on that role. Second, at the same time, many of the hedge funds responsible for the increasing share of activity in UK gilt trading use significant amounts of leverage to achieve higher returns. As chart 3 shows, hedge fund net gilt repo borrowing has been increasing over the past year. Now, the risks posed from highly leveraged non-bank participants are not new to 2024. We've previously set out the potential impact of leveraged investors on financial stability. Indeed, they've amplified a number of the shocks we've seen in the last 5 years, and we covered this issue in more depth in the FPC's most recent financial stability report. But chart 4 here highlights the total increase in hedge fund net repo borrowing globally. And the third factor I want to highlight is the success of some hedge fund operating models is leading to concentration of the market within a subset of funds. We have seen a growth of multi-manager funds where multiple pods invest in different asset classes with the position of different pods intended to be uncorrelated and diverse. Under these models, central oversight applies strict risk management limits on the pods, which can lead to quicker deleveraging in a stress. At the same time, there's also been ongoing popularity of systematic quantitative strategies, which use models and algorithmic-based trading to follow or to try to anticipate market trends. And with greater concentration within a subset of funds and an increase in the overall proportion of gilt market activity channeled through these funds, the bank in its financial stability role needs to monitor and understand what these developments might mean for the financial system. To be clear up front, the developments do not suggest a fundamental issue in the functioning of gilt markets. Indeed, we could confidently say that gilt markets operated in an orderly manner around the time of the UK budget, when 10-year gilt yields moved up before retracing somewhat. This was markets doing their job, repricing based on the impact of news on expectations for central bank policy rates and gilt supply. Taking a step back, though, while gilt markets continue to function in an orderly way, vulnerabilities like hedge fund leverage and concentration are a specific example of the vulnerabilities that could lead to system-wide risks and warrants continued and careful monitoring. So how do we monitor and better understand these risks such that we can take informed actions to maintain financial stability at the bank. At the international level, policy work on leverage in NBFIs and enhancing the liquidity preparedness of non-bank market participants is ongoing. And further international work on regulatory data gaps is upcoming, such that authorities can better monitor the resilience of non-banks. Domestically, steps are being taken to address data gaps, such as in the forthcoming PRA consultation on addressing liquidity reporting gaps and streamlining standard formula reporting for life insurance. One key development I'd like to highlight from 2024 is the recent publication of the bank's system-wide exploratory scenario exercise, or SWES, final report, the first exercise of its kind globally. As my colleague Lee Folger set out in his speech last week, the aim of the SWES was twofold. First, it aimed to improve our understanding of risks to and from NBFIs and their behaviour and stress. And second, to investigate how those behaviours and market dynamics can combine and amplify shocks in markets and potentially pose risks to UK financial stability. Figure 4 sets out the key risk and transmission channels investigated in the SWES. Now, the exercise highlighted how a severe stress could result in very large cash and collateral moves around the UK financial system, and how different market participants and core markets perform under those conditions. Now, I realise this is quite a complicated diagram, and I'd point you to the full 113 pages of the publication or Lee's speech for further details on our findings. But for the purposes of today, I'd like to emphasise 3 things from the broader set of conclusions. First, it highlighted that firms' collective actions amplify the initial shock in the scenario, mirroring the theme I've been drawing out so far in my speech. Second, it highlighted the liquidity challenges that some NBFIs can face in significant market shocks. Third, and most importantly for me in the context of my speech today, during a market stress, banks are generally unlikely to provide all of the additional repo financing NBFIs ask for. That brings me to the final step in my thought process for today, the bank's balance sheet and our lending facilities. The bank's balance sheet operations at their core provide liquidity to the financial system when liquidity is required. Andrew Bailey, in his Goodhart lecture in May, explained the importance of central bank reserves to delivering on our core mandate of maintaining financial stability, as well as implementing monetary policy. As the safest and most liquid of financial assets, central bank reserves act as the ultimate safe asset in the system, underpinning settlement between participants. We therefore need to consider the extent to which we use the bank's balance sheet to provide liquidity to the system. Who should we provide that liquidity to and on what terms? In other words, what is the right balance for our balance sheet operations? Now, the bank's balance sheet is going through a period of transition, and we published a discussion paper today setting out the work we're undertaking to recalibrate the index long-term repo ILTR operation as we transition to a repo-led operating framework. The ILTR, alongside the short-term repo, or STR operation, will supply the majority of the stock of reserves to meet the system's liquidity needs as we transition away from the supply-driven framework we've operated for at least the last decade, where the MPC's quantitative easing purchases, amongst other things, supplied abundant reserves to the banking system. That overarching change in the size of our balance sheet and operating framework is not the focus of my speech today, but I would strongly recommend market participants engage with the discussion paper and share your views. As Andrew Bailey reiterated in his lecture in May, the bank has been open for business through the operation of our revised sterling monetary framework for over a decade now. We want to ensure that our counterparties can access reserves through our facilities as part of routine sterling liquidity management, both in business as usual and in times of stress. This is vitally important as we transition to our steady state, repo-led operating framework. What I want to focus on today is the question of how we provide liquidity to the non-bank sector during stress. Until now, the bank has provided liquidity to the financial system as a whole via the banking system, under the assumption that banks would onward lend and that liquidity would eventually find its way to the part of the financial system where it was most needed. But when core financial markets are severely dysfunctional, as in 2020, or as illustrated in parts in the Suez exercise, we've seen that banks are not always willing or able to pass on sufficient liquidity sufficiently quickly to NBFIs to meet their demand and avoid a period of financial instability. Accordingly, we've been working to develop tools to lend to NBFIs directly in times of severe dysfunction in core UK financial markets, when financial stability is under threat. As a first step in this work, the bank announced in the summer that it is developing the Contingent NBFI Repo Facility, or CNRF, yet another acronym or initialization, but I think it's almost the last one in the speech. The purpose of the CNRF is to backstop the gilt market, the most core of all UK financial markets, given its size, interconnectedness, and importance to the system and to financial stability. The facility will be open to eligible pension funds, insurance companies, and liability-driven investment funds. These sectors are our initial focus, given they have both been significant sellers of gilts in past stress episodes and have higher levels of resilience relative to some other NBFIs. And it will be priced to be expensive when compared to market pricing in normal conditions, but attractive during times of stress. As its name indicates, the CNRF will be a contingent facility, available only when activated by the bank, because we judge that gilt market dysfunction is severe enough that it threatens financial stability, absent any action by the bank, and our lending facilities to banks will not, on their own, eliminate that threat. Now, I understand they'll be interested in knowing for certain when we would activate the CNRF, but it's beyond our powers of prediction to provide a definitive list of which circumstances would lead to the severity of core market dysfunction that would warrant activating the CNRF. What I can say is that the bank will draw on a mix of quantitative and qualitative information to assess whether the conditions for activating the CNRF are met. We maintain regular quantitative monitoring of gilt market conditions using a variety of metrics that can provide useful signals that conditions are becoming dysfunctional. But these metrics are less instructive about what might happen next. It's here where conversations with market participants become invaluable. Our blend of quantitative and qualitative information allows us to be forward-looking and judge when market moves are building to tremors of dysfunction, and when those tremors, if they cannot be managed by firms alone, are building into something that will lead to fire sales and material spillovers to other firms, which would threaten financial stability if they remain unchecked. It's in those clearly severe and hopefully rarer situations that activating the CNRF may be warranted. Now, we understand from our market engagement that our approach to disclosure is a particular point of interest, and that contacts express concerns that revealing too much information could create stigma around the use of the CNRF. It's incredibly important to the bank that we avoid this. The CNRF, like all our facilities, is there so that it can be and should be used once it's been activated. Now, the design and inherent nature of the CNRF should help avoid stigma. This is a market-wide facility, and any use would be indicative of issues in the gilt market as a whole, not problems with any specific firm. And to further mitigate the risk of stigma, the bank intends to publish the number of firms that are signed up to the CNRF, but we would not reveal any names. And in the event that we activate the CNRF, we would only disclose borrowing at the aggregate level. Now, the bank has made considerable progress on the CNRF since the summer. Our conversations with firms and industry bodies throughout the process have been invaluable, in helping us advance the design and ready ourselves operationally. And I'd like to take this opportunity to thank everyone on behalf of the bank who's been involved. I'm pleased to say today that our systems changes are now all in place. The bank is working to finalise a few remaining design details and to put together supporting documentation, including the legal paperwork and a range of user guides to support firms in making an application. We'll be opening for applications at the start of 2025, something we'll make sure we advertise widely at the time. And a final point on this, the bank encourages eligible counterparties to apply and will be on hand to provide help and support. Given its nature and the likely context for activating the CNRF, we cannot guarantee that we will be able to onboard and lend to counterparties that have not signed up in advance of the CNRF being activated. Now, to conclude, as I said at the start, the end of the year is a natural time of reflection. I'm very pleased with the innovative work we have done this year at the bank in developing the CNRF, ready for launch in the new year. The transition work that's continued, the foundational work, sorry, that's continued on the transition to a repo-led operating framework for the balance sheet, as well as the work on the first of its kind SWES that we published 10 days ago alongside the FSR. I'm also mindful that whilst this has been a year of relative stability, that is never a sign that we should get complacent. As famed economist Hyman Minsky once said, stability breeds instability, and the comparatively calmer market conditions of this year could lead to greater risk-taking in future. We must continue to be vigilant in light of increasing uncertainty around the economic and financial outlook by effectively monitoring and assessing risks present in UK financial markets and utilising our balance sheet when it is appropriate to do so. Getting the balance right in our balance sheet operations should help us to maintain financial stability and in doing so lay the foundations for sustainable growth. Thank you very much.
Yeah, thanks very much, Dave. That was really very thought-provoking, and I think does give us quite a lot of things to delve into now in the remaining half an hour or so. So I'm going to be just kicking off myself. We are also allowing people who are visiting us online to ask questions, and so if they do, I would recommend that they put the questions in, have my colleague maybe can read them out if there are any. That'll save a bit of time, I think. So those of you who are online, please, you're welcome to put questions as well. Just starting off with a fairly obvious question about 2022 and the famous episode which your colleague Andrew Hauser called 13 Days in September, I believe. It sounded rather filmic. That, of course, was driven partly by some leveraged operations, the LDI cases, which have been very well ventilated. And of course, the background was a macroeconomic and a political upset, a new prime minister who maybe slightly overdid it at the other end of town. Do you think that that kind of episode, both from a political point of view and now also from a technical point of view, can no longer happen because you've made the necessary precautions, you put the necessary precautions into place, both in the Whitehall end of town, but also at your end of town?
Thanks for that comprehensive question. I won't touch on the political aspects, although I might come back to say something because I talked about it in the context of the budget. But just in terms of the technical aspects, and this is where actually, you have to sort of distinguish between, what we call in the trade stress incidents and then stress tests. The LDI episode, that was a real stress that played out. It was threatening core markets. We had to make, at that point, an emergency intervention with the tools that we had, which was asset purchases into the long end of the market. I think what the system-wide exploratory scenario exercise, or SWES, tells us. Because, the shock in that, and I would recommend people, have a look at this. It is an exercise, it's a stress exercise, not an actual test. Not an actual event. But, the stress there playing out over 2 weeks, I think, when you look at the elements of that and what we shocked, I think it's on a, it's on a scale above, what was happening, what the, if you like, the shock factors going into the LDI episode were. And it's certainly the case that, we've seen in the intervening period resilience by, some parts of market-based finance, particularly the LDIs, funds themselves have improved, in response to our actions, but also this is the point that different parts of the financial system will be doing different things at different times, and they have different degrees of resilience. But what was encouraging, one of the big outcomes of the SWES exercise, was that the gilt market, that core market, there was significant repricing, there was lots of movements around the system, but that core market was able to adjust. So one can take encouragement from that. There is a bit of a rider that, that we based the exercise on positions and positioning indeed in October 2023. So the hedge funds then, and it goes back to one of the slides I showed, but the hedge funds at that point were, I think it was chart 3, were net lenders into the gilt repo market, whereas they're now significant net borrowers. So that would mean a different dynamic for them. Were we to have applied the SWES to now, it would have had different effects. But I guess what we're trying to do with that, though, that whole exercise, is just illustrate, how the system can perform. And, what was interesting about the SWES exercise was where we saw the jump to illiquidity, which, if you like, was what we saw at the long end of the gilt market during the LDI. We saw that in the corporate bond market this time.
Yes, I wanted to ask you about the role of market intelligence, because you do have a lot of people at the bank whose job it is to try to find out what's going on in the market. You mentioned this important point about stigma. If you go too deeply into a particular firm, then it might have all kinds of countervailing effects. You've also got to guard against insider knowledge and so on being traded. So it's a difficult area, but I do understand in the LDI episode, one of the game-changing episodes was that you did change all the software in the bank to allow you to buy up the index-linked gilts, which originally you weren't able to do. And you did that relatively quickly based on market intelligence. And so the worrying thing from my point of view is that when you have all these different market participants, including hedge funds, which, as you say, have now become much more intense in this area, do you actually have enough agents, if you like, circulating? I'm not calling them clandestine. There may be some people who go out in clandestine missions in Clifford Street in the West End. But the serious point is, do you have enough intelligence on what's going on, say, in the hedge fund community, to allow you to make that kind of split-second and really important decision?
It sounded like for a moment there you're getting sort of John le Carre.
Smile is people.
Does the financial system. So, look, you make a very good point about market intelligence, and and just to go back to clarify a couple of things on the LDI crisis. To begin with, we were getting lots, and you mentioned my former colleague Andrew Hauser, who has gone to Australia to be a deputy governor and deal with their financial system instead of ours. But we were around, if you think back, and we documented this in detail in a letter or 2 letters, I think, that John Cunliffe wrote to the Treasury Committee that were almost contemporaneous. We were getting intelligence, over the weekend and then into the Monday as after the fiscal event. as to the problems with, that was emerging at the long end of the market, huge changes in gilt, that we were seeing in gilt, in long end gilt pricing. And so we consciously went in to begin with, into conventional gilts. And then as time passed, and this is where market intelligence was coming in, because we were getting incoming intelligence all day, every day, from the various, particularly from the segregated LDI funds. They were telling us that the illiquidity in index link was not working out, and so we did subsequently manage our, change our systems so that we could deal with that. But the point there about the intelligence, it was also letting us know how far there was to go and how long it was going to take. I was always of the view that the LDI crisis and our intervention response, we were buying assets, but what we were really doing was buying time for the adjustment to take place. And we had to buy assets to support that adjustment. What we're trying to do with the CNRF is not to have to buy assets, but in a repo, a much more repo-led balance sheet, whether in BAU or in what would be a severe stress, be able to do repo operations. Interestingly, one of the, just to finish on this, the SWES, the participants in the SWES, and what was different about it from a usual stress test was it was like a flow test. We were actually, we set it up in two parts and watched how the money would move around the system and behavior would change. And participants in that were about 50, they made clear that they would use our facilities, our existing facilities, the STR, the short-term repo and the ILTR, to the tune of about an additional 20 billion. But because the gilt market, was orderly, it was volatile, but it was orderly through that exercise, I don't think that would have been an exercise where we would have employed the new CNRF, because that wasn't the, but that was in those circumstances at that time. But the real value of this new approach to system-wide stress testing is it enables you to do a sort of much richer what if than a rather conventional static stress test, which obviously also just focuses on the banks. I mean, we can talk about bank stress testing, but I'm trying to do an advert today for these new ones, which are sort of first of their kind.
Well, as you say, you can line up and fill in the form. Just to, as I understand it, can hedge funds apply? Can they become?
Not at the moment,
Not
no.
at the moment. And the other question, which does come up from time to time, is whether hedge funds should be allowed to be primary dealers in the government bond market. I mean, do you think that's got pluses and minuses? Surely they'd have to be part of the CNFI if that was going to be the case.
I think on the question of primary dealers, as I understand it, and I think that it is something that's being considered. At least one, I think, of the new hedge funds is interested in joining, from what I understand. And I think that is something that needs to be looked at as we look at how the market evolves.
Yes. Just a couple of questions from me, and then we will go over to the audience, and there's a microphone circulating as well. Just on, you alluded very briefly to the quantitative easing, quantitative tightening, obviously not going to go into any of the monetary policy aspects here, but given the fact that you've got that market environment in gilts, A, there's going to be a lot of borrowing, and B, the participants have become much more, say, heterogeneous. Do you think there would be a case for you in your QT operations to become, shall we say, more market orientated and not just have the fixed calendar of the sales over the period of 12 months, but for you to vary this according to the market conditions, that you wouldn't be selling into a market which was already under stress, but you could be reversing these operations, become more market orientated. It might, of course, open you to more cases of losses, but it might enable you to make more profits. You might say that's not your job to make profits or losses. I just wonder what you think about it from purely market and financial stability point of view.
I think you've very artfully navigated around the monetary policy.
Surely not.
So look, I mean, it's a good challenge to the approach we do take to our quantitative tightening. But I do think that the approach we've taken has stood the test of time. So we've said that, we always set out 3 principles for quantitative tightening, and they're very much with a view to the market, and the market having to digest these sales that we're making, after over a decade of us purchasing. But I think, we've been doing quantitative tightening now for over 2 years. We started, we were about to start it when the LDI crisis, but we postponed it. And that was because one of our, we've got 3 principles. One is it should be in the background. 2, that, we don't, we're not going to do it in a way that disrupts market functioning. But we do also see a very high threshold for not going ahead with it. Now, that high threshold for not going ahead with it was cleared by what was happening at LDI. So we hadn't actually started the active sales at that point. So we postponed that for a few weeks. But, continue and bring things up to date now, I think, we can say that our approach, and setting out in advance that we will do this, if you like, in a gradual and predictable way to try and make sure, therefore, that those other 3 criteria, those 3 principles are adhered to by setting out well in advance what so each year the MPC votes on what it wants to do. And it's recently, confirmed that for the next year, it's again going to do 100 billion. We've got 87 billion of maturities over the next year. So a small number of active sales. We set out the beginning of each quarter in advance what the auction calendar is going to look like. Because there aren't many, it's completed quite quickly. All of that predictability, I think, helps make sure that quantitative tightening is happening in the background, that the market can understand what's going on with us alongside the government's own borrowing program, which is obviously much, much more significant in terms of active sales into the market.
So the whole paint drying exercise continues rather than putting on a new coat of paint every now and then and letting the paint get damp again. The paint drying exercise still holds, doesn't it? Don't change the winning team, so to speak.
Well, some aspects. I mean, look, I've been talking about events that haven't been boring, but some aspects of central banking we are trying to make as boring as possible.
Just a final question for me before going to the floor. This whole issue about international coordination, you do go to Basel quite a bit. And I believe also before the LDI episode, there was this paper by Andrew Housen, Larry Logan, I think, on a kind of war game, what you might do in terms of a really severe episode such as the one we had. When you go to Basel and you look at attempts to try to build a more integrated banking market and financial market in Europe, are you in a way glad that they haven't made much headway? Because if the banking market in Europe was, say, less balkanized and less fragmented, there could actually be greater financial stability risks, not only to Europe, but to the UK. If you can imagine, Britain going through an exercise like in September 2022, the risks from very integrated, highly leveraged, very functioning banking market coming to the UK and trying to make profits out of the situation might be quite large. So when you look at the rest of Europe, do you look at this both with a positive and with a negative point of view when it comes to their advances in integrating their markets?
Well, I mean, I think you have sort of, I would, you painted a kind of what-if scenario of what would happen on a particular track. I mean, I think anything that supports banking union and credit union, capital markets union, are with a view to supporting, just as our system here, and as I've emphasized, is all about ensuring credit supply to the real economy. It's really important to remember that, I think. It can easily get lost. I think of financial stability as being the absolute precondition for sustained growth. You know, we saw with the global financial crisis what happened when you have financial instability on the back of poor regulation. So I think good regulation, both of banks and markets in the EU, should support, the banking system and then market-based finance supporting the real economy. So that would, and in a sense, then what Basel is about, and going along to the BIS meetings every couple of months, is tracking what's then happening. One aspect of what we do, I'm on a committee called the Committee for the Global Financial System, and it looks at exactly that, the risks, that I've been talking about. I mean, I've been talking about nearly all today about risks in the market-based finance sector, but assessing the overall operation of the system. And that work that you referenced by Andrew Hauser and Laurie Logan was absolutely thinking, internationalizing what I've been talking about today about what central banks should do with their balance sheets to support this evolving system. And I guess, that work continues. There were two things I was encouraging people to do today. One is to sign up for the CNRF, but the other is to think about doing these SWES type exercises, these system-wide exercises.
We'll make sure it catches on. Yeah. I mean, there should be a European-wide CNRF without a doubt, shouldn't there? Should we have some questions from the audience? Yes, please. Gentlemen at the back. Perhaps you could say who you are. Be helpful just to stand up as well, just so everybody can see you. We'll take one at a time. Please make them fairly succinct.
Simon Yule, Positive Money. So how would the haircuts be decided for the scheme? Will the Bank of England have to go for an approach of pre-positioning collateral? Because if there is a market stress and bond values decline, then the ability to borrow against the collateral will be damaged. And would the bank consider approaches put forward by people like Paul Tucker and Mervyn King for 100% of firms' short-term liabilities being backed by collateral pre-positioned at the central bank, in order to combat, I suppose, accusations of moral hazard, which could be opened up to the bank?
Look, really, really rich set of questions. I mean, I think the first thing to say is, look, with the CNRF, we're starting with the most resilient MBFIs, and once we've got some way to go to assess, for example, what the haircuts will be, all of that. But we do, we've got we've had the sterling monetary framework open for business for, properly open for business since 2012. Obviously we've been encouraging recently in that world more and more pre-positioned collateral, because we do think that's important, although you do then have to think about you're encumbering that capital, what can it be used for in other ways. But I think those are absolutely, design considerations, as it were, to work through. I'm not of the view that we need to go for, the kind of, I know I have my open for business thing that might look like we're, more going for 100% in a kind of Paul Tucker type way. That's not the way that we're going, but we are very much in favour of making sure there's pre-positioned collateral.
Good, thank you. There's a gentleman that's also talked. Yes, was that you, please? Thanks.
Thank you, David Robinson, Market News. You said that you won't be giving the precise criteria when the CNRF is activated. Is this in part because of the classic central bank fear that if you set out trigger points, market participants may find a way of gaming the system and deliberately activating it?
Well, I don't see it like that. I see it as giving us some flexibility and some optionality. I mean, I hope in answer to an earlier question, I was clear that, actually with the SWES that we've just run, I don't think we would have needed to activate the CNRF. There were big movements in gilt market pricing within the exercise and big flows around the system, but they were orderly. I would also like to have tools that I could use if it didn't make sense to go to asset purchases for financial stability reasons, which is what we had to do in 2022. So I'd like to have more optionality, more flexibility around my toolkit. Given, you don't know what's going to happen. And I guess that's the other thing. We're in a world of, I know it's a cliche, but increased uncertainty, the potential for vulnerabilities to manifest themselves, for risks to crystallize. So I don't want to sort of, tie myself down, particularly, with ex ante, with a completely new tool. I mean, you can at least argue with some other tools that we have in our toolbox that you can begin to see what the reaction function is from when we use them, or when we're forced to use them because the toolbox isn't broad enough. With this one, it's brand new, and I think the way we're trying to do this is we'll learn as we go, and if we're challenged that people aren't signing up, because I tried to give that message at the end that if we actually suddenly find ourselves in a crisis, the last thing I want to be doing, back to your point, is trying to onboard people with my systems at very short notice and very quickly understand what their balance sheet looks like. I'd far rather have more time to do that, get them to sign up ex ante, explain to them what the system is and isn't doing. So that's really the rationale. Sorry, what the tool is doing. That's more the rationale than that we're playing some. I don't see it that we're sort of deliberately withholding information in order to stop us being gamed.
Yes, so the more the merrier, that's what you're saying,
Yeah.
so long as they meet the eligibility criteria. Are there any questions online from anybody? Because we could make a note of that. If there are any, could somebody read them out?
Always the ones in the room, though, are,
most important. Yeah. So perhaps you'd like to put your questions, sir.
just because people have made the effort.
Yes, to all these people. Can we have a microphone? Yeah, thanks.
Hi, I'm Thomas, reporter for Central Banking. The non-bank exposure to financial stability, that's not an issue that's only in the UK, obviously around the world. So do you see other jurisdictions, other central banks begin to adopt something like the CNRF in the future? Not just the big countries like the Fed, but also smaller open economies that are particularly open to these non-bank risks?
Look, what I would say is that there is a lot of interest in the CNRF, in the central banking community. I think people will be, very interested in, once we actually when I say operationalize it, how we, because hopefully, because it's contingent, you hope you don't actually put it into use. But how we run the onboarding and all of that. I think that again, from BIS and other discussions, there's a lot of interest in that, and also it comes back to the fact that when you this was a kind of top line message in the in the recent financial stability report. We've seen that core markets are functioning well, but we've seen risk premia being further compressed. I'd argue that a lot of markets are pretty priced for perfection. So if you don't see, those macroeconomic forecasts of continued growth, inflation staying, relatively close to target, fiscal policies staying sustainable, if you begin to see, yields moving around because short-term interest rate expectations change or term premia change, you've definitely got the vulnerabilities then, throughout the system where you can see those kind of amplification points that I was talking about. So, I mean, back to something David was saying earlier, to me, there's no doubt that when we went through the LDI crisis in 2022, it was, it was something, it was an episode that lots of other countries were kind of looking at us and thinking, oh, all right, that, we need to look and see if we've got, both at the macro level, our monetary and fiscal policy, not working in tandem. What does that mean for the potential, what could happen in core markets? What could that then mean for vulnerabilities and those amplifying? So I think there's a lot of consciousness raised around incidents like that. Similarly then with the volatility that I did focus on this August. And, you've got the yen carry trade, that was certainly a trigger back in August, but then there was the amplification from leverage. Something we talk about in the financial stability report. You've got, the US Treasury, you've got the basis trade there, hedge funds very involved in that. So there are lots of things to keep an eye on, and therefore a lot of interest in these new types of tools.
Well, I did want to write it in, just bring up one macro point, but there's just one question. Yes, is there a question at the end? Yes, so let's have these two together, because we're starting to run out of time. So perhaps if you put your question, and then we'll have this gentleman down here also.
Thank you, Lawrence Picton from WWF. Yeah, I also used to work at Treasury, but I focus on sustainable finance now. So I wanted to ask quite a general question on what your view of the bank's role in managing potential risks to financial stability from climate change and nature losses, particularly for the Suez exercise.
That could be quite a short answer, perhaps, because it's not really the question today. But I'm going to hand you my mic.
I will, but no.
We'll have these two together, and then you can answer them.
Oh, okay. I'll come at you.
Very quick, please.
And Greg Ritchie, Economic News. Given their growing importance that you highlighted in the speech, do you envisage a need to expand access to the CNRF to hedge funds? And if so, what would be the considerations you have to debate?
All right.
So look, both those questions, I'll answer them both from the perspective of the balance sheet. Look, we did, just to give you an indication, we're still very focused in the bank on climate risks, but I would say that we are mainstreaming them into all of our activities, whether that's, the physical risks or the transition to, net zero risks. And just to give you one example from my responsibilities, this is going back, probably a few years in the 7 and a bit years I've now done as a deputy governor, but you might recall that we used to have the corporate bond purchase scheme. We did 20 billion of corporate bonds, and we did that and initiated that after the, I think, did we initiate? Well, we certainly did some of that during COVID, in the initial reaction to COVID, but then we tilted that towards, less polluting companies. So we felt that was all, we certainly weren't going to go as far, although we were challenged, shouldn't you just divest, what you're doing there. But what we did was tilt the remaining purchases towards companies where, under certain criteria, we could see that they were more focused on, making the transition. And that meant that we would, it wasn't just very green companies. We were looking at companies that were greening their balance sheets. And we took account of that. It was something the ECB did as well, but we actually, I think, were among the first to do that. Unfortunately, the purchases ended very quickly after that. But it does
give a very small amount as well, wasn't it?
Well, no, but it's just an example that, in a sense, we're trying to do what we can in our operations, but we're only part of a wider financial ecosystem. And then on your point, hedge funds, don't have access at the moment. The CNRF is around, the one, we're looking at, the insurance companies, the life insurers, the LDI funds, in a lot of cases, either through our experience with them or because we directly supervise them, we know that they're regulated. That's where we started, but that's certainly not where we can stop. There's going to be further phases as we open this out. But, it's going to, we've already got, compared to, when I was the chief economist at the Treasury, we've got an awful lot more and much more diverse membership in terms of the sterling monetary framework, which is basically what gives you access to our balance sheet. We'll be going further with the CNRF and, watch this space for where we go beyond that. And it will make for, a more effective balance sheet. It'll be a bit more complicated, time consuming, operationally difficult to manage. It means we've got a broader toolkit that we can use in a broader range of circumstances. And that must be good in terms of our job for underpinning financial stability.
Just a last point from me, if I may.
That sounded like a good set of concluding remarks.
No, well, I seem to remember that you were at one stage the head of the Committee for Diversity at the Treasury. And so, in fact, what you talked about regarding the diversity of the gilt market is quite a good segue into what you're doing now. Just a last macro point, because you did make the point about the exemplary effect of 2022. I remember one of the central bank community immediately afterwards, he said, this is an example of fiscal hooliganism. That you also had the IMF statement, you had the ECB saying it was a wake-up call. In a way, Liz Truss should have been given a Légion d'honneur, I think, because she did make the point very well what not to do. But you remember immediately afterwards, your old colleague Nick McPherson, he said, Treasury orthodoxy is back with a vengeance. Is that the lesson? The Treasury orthodoxy, partly as a result of that episode, is now ruling the waves?
I'm not going to comment on Treasury orthodoxy. Aren't we out of time? No, I mean, I'll leave that debate to continue. But I guess what I would say is, I mean, I mentioned this in my speech. What we saw, because we commented on this also actually in the monetary policy press conference, we saw some repricing of gilts after the budget, but it was very orderly indeed. In fact, 10-year gilts now, looking this morning, I think are just slightly below where they were the day before the budget. I mean, that just shows that the gilt market, pricing moves around. That's what you'd expect from a market, but it also shows that there's not been any sort of sudden, big, significant repricings.
Yes, I think it has been a salutary effect. Look, I'd like to say thank you on behalf of us all, Dave, for you coming along. It's a really illuminating talk, and I do hope the CNRF will go from strength to strength. Maybe you should offer occasional lunch at the Bank of England to get people to sign up, and then they'll all be along, with their Christmas cards. They'll be sending in their application forms.
Or they could take me out to lunch.
Thank you very much indeed for coming along.
Thanks very much. Thanks, David.
That was good. Thank you.